Today, we're diving into the world of REITs, real estate investment trusts. If you've ever wanted to invest in real estate without the headaches of being a landlord, this is for you. We'll break down the different types of REITs, their benefits and drawbacks, and how to choose the right one for your investment goals. Let's get started. First off, what exactly is a REIT? A real estate investment trust is a company that owns, operates, or finances income-generating real estate. They provide a way for individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any properties themselves. There are several types of REITs, each focusing on different property sectors. Let's break them down. Equity REITs. These own and operate income-generating properties like residential apartments, shopping malls, and office buildings. They earn revenue primarily through leasing space and collecting rents. Mortgage REITs, MREITs. These provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. Their revenue comes from the interest earned on these loans. Hybrid REITs. As the name suggests, these combine the strategies of both equity and mortgage REITs, allowing for a diversified investment approach. Specialty REITs. These focus on specific sectors like healthcare facilities, data centers, or even cell towers. They can offer unique investment opportunities depending on market trends. Now, let's talk about why you might want to invest in REITs. Here are some key benefits. Income generation. REITs are required to distribute at least 90% of their taxable income as dividends, providing investors with a steady income stream. Diversification. Investing in REITs allows you to diversify your portfolio with real estate exposure without needing to buy physical properties. Liquidity. Unlike traditional real estate investments, many REITs are publicly traded on stock exchanges, making them relatively easy to buy and sell. Professional management. REITs are managed by experienced professionals who handle property management and strategic decisions, which can reduce risk. Of course, there are downsides to consider as well. Market risk. Since many REITs are publicly traded, their prices can be volatile and subject to market fluctuations. Interest rate sensitivity. REITs often react negatively to rising interest rates, which can impact their ability to borrow and, in turn, affect dividends. Fees and expenses. Some REITs come with high management fees that can eat into your returns, so it's essential to review these before investing. Finally, how do you choose the right REIT for you? Here are some tips. Research the sector. Understand which property sectors are thriving and align with your investment strategy. Check performance metrics. Look at the REIT's historical performance, dividend yield, and funds from operations, FFO, to gauge its stability. Assess management quality. Evaluate the experience and track record of the management team running the REIT. Understand the fees. Review the fee structure carefully. Higher fees can significantly impact your long-term returns. Consider your investment goals. Align your choice with your financial goals, whether you're looking for income, growth, or diversification. So there you have it. A breakdown of REITs, their types, benefits, drawbacks, and tips on how to choose the right one for you. If you found this video helpful, make sure to give it a thumbs up, subscribe, and hit that notification bell for more investment tips. Have any questions about REITs? Drop them in the comments below. Thanks for watching, and happy investing!